Yeah. Two. Yeah. Aye. I'm jacking the beat, you calling the cops, the yapping is cheap, I call you the ops, the rapping is hating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit, you tipping and hit up the cash app. Baby girl, been around for it, yeah. In the old days, I was stuck in old ways, never really trying to flip the old page. Young man tripping at an old age, thinking I was flicking, had a low wage, led the broad days, then a slow praise, thinking it'd be different, it would gon' change, then it really didn't, it's a cold game, yeah. Ay, all I really wanted was the money in the pocket, got over money, but the money ain't a topic, like Bill Doe and the money gotta stop it, kid need food and the whip need juice, I'ma get these views when the work hard, play hard, homeboy, everybody ain't calling out. Got a mouthpiece from the southeast, if you want scrap, stall him out. If you don't know what I'm talking about, then I feel good, man, I'm balling out. I'm a rich man with a rich fam, Christ bars got me out of mama house. And I bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace. Big God, big grace. Big God, big grace. Big God, big grace. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.
What it do, y'all? It's your partner looking old, so fresh, cold, clean. You see that thing, guys, and welcome to another edition of the Countermove podcast, where we kind of look at a situation or issue, kind of lean in and reason together, and then prescribe the right solution. So welcome, guys. Welcome. This is going to be a really good one, guys. If you could, before we begin, if you could subscribe to the channel, guys, which would be pretty good, and like so we can get the algorithm up. If you like our content, and if you could share to anyone that you may know, if you're getting value out of this content. So, guys, let's dive into this real quickly here. All right. There's been a lot of news going on concerning the economy. We had some inflation numbers that came back that was not good at all. Of course, the PPI and the CPI are still up. You have the manipulating of facts when it comes to the government, how they changing definitions. And they're, of course, changing metrics of how they get to a certain number in order to present a certain picture to the masses. And it has not been looking good at all, period. Even with all the spinning and all of the recalibrating and redefining of definitions, the economy is still in bad shape, guys. So, and the reason why they kind of do this is because it's the art of the spin. The spin is, if you don't believe what you see, believe what we're telling you, and that's called foolishness. All right. So, guys, the one thing that I did kind of get some information about, it was a new term that a friend of mine went to one of his conferences. Pastor Bede brought up was something called a reverse market crash. Some of you guys have probably heard this for the first time before. Again, a reverse market crash. You've heard of a market crash. How about a reverse market crash, guys? To where is the market crash up, not down? And I thought it'd be wise for us to look at some details, guys. And also, we're going to also dive into the Treasury bill auctions. There was an auction, guys, that actually happened that you guys didn't know about at all, to where the Fed sells the bonds and the bills. Let me tell you this. It didn't go as good as it should have went at all, period, because of the condition of the economy, guys, and the faith of the investors themselves. So let's dive into this real fast. I'm going to bring in Patrick real quickly. And Patrick is going to talk about this concept real quickly, guys, of a reverse market crash. This here really piqued my interest because he dives into some numbers, some deep numbers that I think we should begin to look at. Put your emotions to the side. Please don't bring your own assumptions to the table. Listen to this from an authentic perspective and listen to the facts. All right. Once you gather all the facts, we can kind of lean in the reason together, guys. No, don't worry. I'm going to prescribe some right solutions. So let's see what Patrick has to say about a reverse market crash. Let's dive into this thing. Here we go.
what's worse than a market crash? A reverse market crash, a concept I've been talking about on the podcast. So what is a reverse market crash? That's when all of a sudden the market just balloons up. And you're like, wait a minute, what happened? And you're trying to hold it. And you see the rich get richer and the poor get poor. Now, Pat, how is that even possible? I want you to look at this chart from Pew Research. Everybody that's a politician that becomes a governor or Congress or Senate, they all want to claim, we got to help the middle class. We got to help middle income. But look what this data is telling us from Pew Research. According to this data, if you look at the green at the top, that's upper income aggregate wealth in the U.S. Yellow is middle America, middle income, and the light green is lower income. To the left, the wealth in America, only 60% of it was with upper income back in 1983, 32 was with middle, and 7 was with lower. Fast forward to 2016, it's even worse today. It went from 60% of the wealth to 70%. Middle income went from 30% of the wealth down to 70. That's a drop of nearly 50%. And
I want you guys to see this picture. You see the picture right here, guys? Look at the wealth gap. Look at the wealth gap, guys. Look at it. This is not for the faint. Look at the wealth gap. It's clear. It is clear. Look at the wealth gap, guys. It's crazy town. Let's keep listening. Here we go.
And lower income went from 7% to 4%. That's a drop off of 40%. So you may be asking, where are we going with this? This is the point. Every time we're printing money to assume and say these politicians, we're helping the low and middle income family. You give them money. Guess what? They don't know how to do. They don't know how to save. They're experts at spending. The government doesn't teach them how.
That's a great point. Think about this. When it comes to the masses, are the masses experts in saving money or spending? In other words, are we experts in consuming, spending, or producing, saving, or investing? Which one, from a masses perspective, or is the masses really good at? I would say consuming, spending, because they have not been taught how to save. That's why people don't like budgets. Let's keep going. Let's see what Patrick's talking about. Here we go.
Teach them how to save. They just give them the money and they know they're going to spend it. And then when they spend it, what do they buy? They buy a product. Somebody owes them. They owe this. They buy a camera. They buy a drink. It goes to the companies.
It does.
So you give the money to the poor, knowing the money is really given to the poor.
Right.
It's going to flow to the top, which is who? The rich. That's how the rich keep getting richer and the poor keep getting poorer. And these policies not going to stop. By the way, the other day, Jerome Powell says he's not raising the rates. You know what happened to the S&P 500? Boom, 5% within a week. So what if all of a sudden?
You see what he's talking about? He talked about when the Fed chairman said, wait a minute, I'm not going to raise the rates at all. What happened to the S&P 500? It went up. Now, some people may say, well, that's good for my 401k or my retirement account. Wait just a minute. Listen to what actually happens after that, which is going to affect the value of the dollars in your 401k or retirement account. Here we go.
Of a sudden, Powell in the next few months, we're lowering the rates. You could see S&P and Dow just go boom,
yes,
boom,
yes,
boom, boom,
yes,
boom, which is called a reverse market crash.
Exactly.
Something the wealthy would want, not something you would want for low and middle America. We're going to talk about that today. Okay, so if you get value out of this video, give it a thumbs up, subscribe to the channel. Let's get right into it. I'm going to give you a few examples of what a reverse market crash could like. Case studies, actual reality, what happened. One is Germany, one is Zimbabwe, one is Iran, one is Argentina, one is Turkey, and maybe a couple other ones. But let's start off with Germany. So back in the days, in 1914, 1913 or so, if you wanted to buy a dollar and convert your currency from Germany marks to a dollar, you needed 4 marks. Again, this is 1914. So hey, here's 4 marks. Here's $1.
Yes.
You with me so far?
Yes.
9 years later, in 1923, you know how much it took to just get $1? How many marks?
Yeah.
1 trillion marks. Did you?
Stop right there. This is called a fiat currency. You're seeing the effects of fiat currency. There's nothing new under the sun. This is fiat currency at its best. Come to me for a second. Look at me real fast, guys. Every fiat currency that's ever existed, guess how many have succeeded? 0. They have 100% failure rate. Let this sink in. A 100% failure rate is the fiat currency history. Every fiat currency has failed. All right, let's dive into it again, guys. Again, not trying to scare you. What I'm doing is I'm giving you the facts. Numbers, not theory, numbers. Let's get to it.
Hear what I just said. It took 1 trillion marks to get $1, and it only happened in 9 years.
Crazy.
Now, why? Let me explain. After losing World War I, the Treaty of Versailles forced Germany $33 billion in reparations. So during this time, Germany lost a significant amount of territory where it was manufacturing goods. They were forced to print money to meet the reparation demands. This simultaneously added money to and removed goods from the economy. Catastrophic. By 1922, price had risen by nearly 700%.
Stop right there. Does this look familiar to you? Germany lost a significant amount of territory where it manufactured goods. Who has become the manufactured power of the world, really? China now, right? Number two, Germany was forced to print money to meet the reparations demand. What are we doing? Printing more money. Does it sound familiar? Number three, this simultaneously added money to and removed goods from the economy. What's happening right now is the world doesn't want our currency. They want our goods and services, which China is providing, right? Number four, by July 1922, prices had risen by nearly 700%, causing hyperinflation. What's happening to our country? We haven't got to hyperinflation yet, but it's beginning to creep there a little bit. Does any of this look familiar? There's nothing new under the sun. Let's keep going.
Hyperinflation, the government had to print million mark notes, then billion mark notes. And by the way, you ever hear the saying a wheelbarrow full couldn't even buy a newspaper? This is kind of where it comes from, because this is when it went from 4 marks buying $1 to 1 trillion marks buying $1. And Bob, just to kind of show you some data here, if you look at this chart here, this shows you from 1918, where it took roughly 100 marks to buy US dollar, goes 5 years later to 1 trillion marks, right? That chart tells an entire story.
You ever wonder why Jamie Dimon, CEO of Chase, has a 900...
So guys, let's stop right there. I want you guys to see how this is not. I want you guys to kind of see exactly what's going on here. Is if you look at what happened with Germany, it's kind of sounding a lot about what's going on in the United States. It's sounding just like it. Am I tripping? I'm off base? I mean, this is what it is. Let's keep going though. Now let's go to Zimbabwe. Let's go to Zimbabwe, guys. Again, there's nothing new under the sun. Nothing. All right. Let's keep going. Let's go back to Patrick and see what's going on. Here we go.
That was worth only 40 US cents.
Crazy.
In the early 2000s, Zimbabwe government attempted a land redistribution effort which disrupted the farming industry, causing an agricultural production collapse. After monthly inflation peaked by one measure at 79 billion%, the government in 2009 abolished their dollar and began using US dollar instead. The currency switch brought monetary stability for a few years until the Reserve Bank of Zimbabwe could no longer meet the demand for US dollar. Money stored in the bank accounts could no longer be withdrawn in cash, and in early 2019, the central bank reintroduced the Zimbabwe dollar, changing US dollar denominated savings and domestic government debts into a local currency of rapidly declining value. You want to know what this did to the stock market? Take a look at this. This is Zimbabwe's stock market. Notice how everything is flat, smooth, everything's good. Maybe a slight pickup there, and all of a sudden, boom, stock market skyrockets to 517,412. Now, that's the stock market, but what caused this? Take a look at the inflation. If we look at this chart here, upwards of 800%. And if you go to their interest rates, look what their interest rates, 200%. Can you imagine buying a house on 200% interest rate? That's what happened to the Zimbabwe. Now, some people will say that'll never happen to the U.S. Never going to happen because those were not real interest rates. And now you may be saying, Pat, I mean, I know how you're doing this with the inflation rate and the interest rate, but that's not the real interest rate. Well, if you want to look at the real interest, here's what you'd be looking at. Even if you look at this, look what the real interest rate was in 2020. Minus 30%. What do you do with minus 30%? Do they pay you? Like if 10% I'm paying, are you paying me now when it's minus 30? Imagine how much of a shit show it was in Zimbabwe. And by the way, if you want to calculate that in U.S., the real interest rate would be if inflation is percent and interest rates are 3, the real interest rate is the difference between the 5 and the 3, making it 2. Here, it's 30% minus 30% in Zimbabwe. So that's Zimbabwe. Now let's take a look at Argentina. Here's Argentina for you. 70 years of welfare policies. A third of the workforce is employed by the state. Most spending goes towards salaries and pensions instead of investment, technology and infrastructure. Fiscal deficit for the last 13 years. Constant printing and borrowing. biggest IMF borrowed of IMF debt as of 2023. There were price caps on over 1,300 consumer products. And what does this do when you take free market out? Take a look at their stock.
Now, does that not look familiar? Just the fruits of the tendency of what's going on. Doesn't that not smell just like what we're doing in America? Be honest. Let's be honest with this. Let's keep going.
Stock market, what it did from 2020. Look at that chart right there. It went from roughly 20,000 to what? Nearly 640,000. That's what you call a explosive reverse market crash. And what were the similar situation here as Zimbabwe? Not as bad. So I'm going to show you this again. If you look at this chart with Argentina's real interest rates, notice this, they're also in the negatives, right? And if you look at the bottom, the difference between interest rates and inflation, you typically want interest rates to be ahead of inflation. Notice what happens in 2022 when inflation, they bring the interest rates down, hoping to fix the economy. What happens to inflation? Gets ahead of it. And now they're chasing after inflation to not lose it. The reason why we're showing you this, because in America, if Powell all of a sudden gets pressure from the top to say lower interest rates, inflation could go back up again quickly. So managing this and how they could lose control over it, it's going to be a lot of pressure on Powell to not be tempted to want to please an administration and hold it together. Now we'll see what we're going to do. If he lets loose, you're talking about reverse market crash we'll experience in the U.S. Now let's take a look at Turkey. Okay, they got the #1 military in the Middle East. If you look at Turkey, last October, inflation hit a 24-year high with 85.5% on an annualized basis, meaning prices nearly doubled. Erdogan started cutting rates while the U.S. was hiking in 2022 against the advice of several Turkish central bankers that he ended up firing. And what happens to the Turkish stock market? What do you think? Take a look at this. Same thing. It goes from 1,000 roughly to 7,700. That's 700% increase in just a couple of years. And what were their real interest rates? What do you think? Take a look at this. Also in the negatives. And if you look at their inflation, guess what you're looking at on this next chart? Same exact issue. Notice a trend. It's a similar thing happening. America and Jerome Powell's got to keep it together, or else we're going to have similar things happening here. Let's continue. Iran. Here's Iran for you. Look at their stock market. Same exact thing. 2018, 2019, 2020, slightly of a growth. And then 2020 to 2021, boom, skyrockets to 2 million. And then eventually to 2.5 million, their stock market. And if you look at Iran's inflation rate, what do you notice? Take a look at this. It's not as high as some of these other guys, but 40%, 60% interest rates, upwards of 22%. And then here, real interest rates in Iran, guess where it's at? It fell down to negative as well. And they've been trying to control it ever since. Similar issues. And last case study here is Venezuela. Venezuela's high inflation levels are due to relying heavily on imports for basic goods, depending on oil as its main export, inefficient government industries, governmental corruption, price controls, government subsidies, and most of all, sanctions.
Do you see a lot of government involvement in these type of bad economic time frames? Free market is being removed out, right? Capitalism has been trying to be moved out, and the government tried to step in to fill that gap because the government forced them out. Do you see what's actually happening? This is nothing new, guys. It's nothing new. Let's keep going.
May 18, 2006, President Hugo Chavez from Venezuela declared on Tuesday that Venezuela would consider putting the sale of its oil in euros. In 2017, Trump aggressively tightening sanctions with the aim of ousting Maduro in favor of an interim opposition government led by Juan Guaido. The Trump administration cut off by Maduro's regime's access to the U.S. financial system, barred U.S. companies and citizens from purchasing Venezuelan debt, and blocked PDVSA from exporting to the United States, its primary destination. By the end of his term, Trump had issued 7 executive orders targeting state or affiliated companies, government agencies, and the central bank. Venezuela's hyperinflation rate increased from 9,000 plus percent to 10 million percent from 2018 to 2019, according to the IMF. And by the way, if you take a look at this chart from Venezuela's inflation rate from 85 to 2024, look what happens after Trump did that to Venezuela in 2017. It skyrockets all the way up to what? 65,374% inflation. Look what happens to their stock market, the most bipolar stock market you can think about, where it goes from a couple thousand to 62,000, causing a reverse market crash. So take a look at this next chart of OPEC, crude oil, what happened in Venezuela. Their export kept going lower and lower and lower because that's what sanctions do. And again, with their interest rates skyrocketing all the way up to 50, 40, 60%. And they also had negative interest rates all the way down to 20%.
Wow.
Now, to give some hope to Venezuela, take a look at this year, 2014, 15, 16, 17, everything has declined just barely. They came back up in 21 and 22 because President Biden is willing to release the sanctions so they can start selling oil again if Maduro is willing to have free and fair elections. That means we have trust he's going to do it. Whether he will or not, we won't know, but he said he will. Now, you may be saying, Pat, this is great, all these examples you're giving. We're not Zimbabwe. We're not Turkey. We're not Iran. We're not Venezuela. Are you out of your mind? That'll never happen to us in the U.S. Okay, let me show you a couple things here. Take a look. Maybe you're right. Maybe I'm wrong. Who knows? But if you look at our inflation rate from 2000 till today, notice what happened in 2021, 22, skyrockets, right? Look at the rates on the next page. Our real interest rates, if you look at that, we went in the negative slightly, okay? Now, 2020 goes in the negative. 2013, we flirt with negative. And if you look at our effective rate at this other chart, you'll also notice where we went there. We were also flirting with 0, 0, 0 for God knows how long. And take a look at S&P 500. Look at this here, SPX. What do you notice? And roughly in 2009, SPX was at 700. Where's it at now? Roughly 4,300. It's 6x. That quickly? You mean to tell me that can go 6x like this? That's what the chart is telling me. In America, for it to happen, what are the criteria? What do we notice here? Number one, in every one of these countries, we have quantitative easing, which is what? Printing money. We did a lot of that in the U.S. Number two is when the government chooses to get involved with free market and they want to kind of create regulation and all these rules. We got a little bit of that going on. What's number three? Price controls. You got to put the price of oil at these. Some people want to flirt with it. Newsom wanted to flirt with it. Biden wanted to flirt with it. Those are the areas when you hear languages like that, we have problems coming up here. Now, why will it not happen in the States? That's a fair question. So again, the three is what? Quantitative easing, which is printing. You got getting involved in free market and price controls. But outside of that, who's typically screwing this thing? Like, who's going to ruin this great idea called America? Politicians. By what? More welfare spending, more money printing. Couple things that may come up is if this idea of reparations becomes something that they want to do, and then you and I got to pay for it, and we've never been a part of it. I'm from Iran. My family to be involved with this, but we got to pay for it because this is what America wants to do, or UBI. There's just a lot of things going on. By the way, the other threat is the following. U.S. dollar, we know it's strong. We already talked about the 80% and the 60% currency worldwide using, but what if all of a sudden these guys are having these meetings, right? The World Economic Forum, or all these other meetings that we're having, these summits that they're getting together. Let's create a CBDC that the whole world uses. Everybody around the world uses the same exact, central bank digital currency that we use, no longer the U.S. dollar. You know what happens to us? We lose leverage. That's not a good thing. We want to keep and maintain that leverage as we have the money that allows us to keep us safe because people rely on the dollar. Trust me, a big part of our economy staying strong is the reason why America is a pretty safe place to be at as well. If we give that up, we give up leverage, then you're helping the enemy in other countries that we do not want to do that. But if we stay put, we monitor and hold our politicians accountable and presidents that want to keep printing money, we scream off the top of our lungs like, slow it down. We want accountability. We want to see what kind of money you're spending on. We want to be kind of pump your brakes on all this money we spend. If we do that, we have a shot at this reverse market crash not taking place in America, specifically if Powell doesn't all of a sudden start being tempted to lower the rates. If you got that,
stop right there, guys. Normally I'm stopping and starting doing a lot of this. I wanted Patrick to go in and just inundate you with facts. Just facts, data, facts. I want that. Now, do I believe that we're going to stop printing? No, they cannot. Unfortunately, the House of Cards won't allow for them to stop printing. They cannot at all. Listen to what's going on, even when it comes to this budgetary situation that's going on. You have both Democrats and Republicans arguing over the budget. You have one side, which is really conservatives that really want to kind of cut the spending, really a small segment of them. But you have a large segment of the conservative side and a large segment of the liberal side, Democrat side, want to keep printing and printing and printing. There's a reason why they print all the time. Number one, they're getting rich off the printing. It's called a grift. Then number two, what they're doing also is paying back their special interest, right? And number three, they cannot, because if they stop printing, the House of Cards falls. Okay, all right. No problem with it at all, man. That was so much good information, and Destin, man, thank you so much. Thank you so much for sharing this here. We're not done, guys. We're not done. Thank you so much for sharing. Now, there is something that goes on behind the scenes that most individuals really don't pay attention to or even know about. We hear about government bonds. We hear about treasury bills, right? That's where a lot of the creation of money is being made. Money is just debt, guys. So cash is just debt. It's borrowed. It's debt, right? That's how money's created, is through debt. Well, what's behind the creating of this money? Well, bonds and treasury bills, right? Or that could be called T-bills. Now, there's an auction that actually happens behind the scenes to unload these originated bonds and treasury bills. Something happened that you didn't hear about at all, and it didn't smell that good. For this one, guys, I gotta bring in our guy, Mark Moss. He actually talked about this, and man, he went in on this, man. And I want you guys to hear exactly what he's talking about on this one, because this portion is not talked about on the news, whether it be conservative or liberal, and a lot of independents. He's one of the few talking about it. All right. Again, this is the Treasury bill and bond auction that takes place. Listen to what actually happened. All right. Here we go. Let's dive into this real fast.
News, and there's what it means. The news last week is that the U.S. Treasury's auction was the worst we've seen in over a decade.
Wow. Okay, let's stop right there. 30-year Treasury auction breaks bad, sinks stock market. It was the worst. He coming in hot. Let's keep listening to this, man. This is pretty good. Here we go.
Causing Moody's agency to downgrade the U.S. credit rating.
Again, another downgrade of the credit rating. Right? Another one. Now, it went back up, of course, but another downgrading. Twice. Let's keep going, guys. Let's keep going.
This is the news. You've probably heard that. But what does this mean for the United States, for the dollar, and for our money and our investments? Now, don't worry. I'm going to make this complex story easy to understand so you know exactly what's going on and how to prepare. So in this video, I want to break down how the Treasury auction works, why it was so bad, what trend we're on, and what happens if it gets worse and if it fails. Why the end game could be in the next 90 days unless the Fed and the Treasury pull out another magic trick. This is a big move, so let's go. All right, real fast, if you're new to the channel, my name is Mark Moss. I make these videos to change the way you think about money because it's hard to understand what's going on. So I try to take these complex subjects and make them easy to understand, and not just easy to understand, but so what? Make them actionable. And so let's dig right in. Last week, Friday, the markets were shook hard when the U.S. Treasury auction struggled. Now, some might even say they came close to failing. When we saw Moody's, a credit reporting agency, they actually downgraded the U.S. government's credit to negative. From stable to negative, citing large fiscal deficits and a decline in debt affordability. Now, this is
so the reason why they actually downgraded the credit rating is because of deficits, i.e. printing, and also fiscal responsibility of paying back debts. This is something. Good to see you. Good to see you, Destiny. Good to see you again. Here we go. We diving into this thing. Here we go, guys. We not done, man. He's finna go in, guys. Here we go.
really big news, so let's just jump in. Now, just real quick, shout out to my good friend and my partner in the Bitcoin Opportunity Fund. I'm talking about James Lavish. He writes a paper called The Informationist, and he wrote about this. I got a lot of the content from that. I'm going to link to it in the show note down below if you want to read even deeper into this. All right, so you already know. The U.S. government is spending like a drunken sailor, and everyone's waking up to the reality that the appetite for others to buy the U.S. government debt, to buy the demand, is just not there. It's not big enough to eat up all the supply the Treasury needs to offload. And so
Again, the world does not want our currency or our bonds or our T-bills, which is really the currency. They want our goods and services. This is the reason why the T-bills, the Treasury bills, and the bonds are not attractive, because they don't want them. They want the goods and services. It's hard to understand.
Last week, the Treasury announced that the amount of the borrowing for the auction would be smaller than most people thought it'd be. It was actually going to be $76 billion less than they had borrowed the previous quarter. Yeah. And even more importantly, they announced they would continue to borrow more short-term debt than the longer term.
Crazy.
Now, it seems like the Treasury is starting to wake up and realize that the world's becoming deeply concerned about the amount of debt they need to continue to operate. And so then by releasing fake numbers by releasing the numbers lower than expected.
Now, what do we mean by fake numbers? Very simple. Changing definitions, changing metrics. That's all that means, guys. Fake numbers, that's all it means. Changing definitions and metrics. That's all you've done. Those produce fake numbers. Simple. You're lying to the people. I digress. Let's go back into it and let's see what's going on with this, man. Fake numbers. Can't make this crap up.
Expected, they would hope to squash some of those fears. Now, for some, that game might work. But for you, if you've been watching these videos, if you've been paying attention, then you know that the Fed seems to release one set of numbers, a budget. They make the headlines. They hope to squash the fears, but then quietly they revise it later.
That's called spinning.
When they hope no one's watching. But of course, we cover it all the time. But here's a few important things that we can decipher if we read the report. I have a couple things here. So first, the primary dealers, they said, the primary dealers, which are the buyers of last resort, explicitly noted a high degree of uncertainty overall around deficit and growth forecasts.
Here we go.
So if we decipher this, to what this means is that the Treasury is admitting that the buyers of last resort, admitting the primary dealers are concerned with being stuck with debt.
That's correct.
The second point that they said in the report is that they said the Treasury anticipates that one additional quarter of increases to coupon auction sizes will likely be needed beyond the increases announced today.
Wow.
You see what they're saying? The Treasury is basically telling you what I said. They're telling you right there that they're underreporting the amount of debt that they're going to need to issue. And then
Trash, garbage, horse manure, pick a word. Again, produces fake numbers and fake results. No problem. Here we go.
there was a third point, which is in the report, which is a really big one. And it said, quote, Treasury continues to make significant progress on its plans to implement a regular buyback program in 2024, end quote. That is the telling piece. We talk about how many more tricks do they have up their sleeve, and they're telling us what they have right here. They're telling us that they have another trick up their sleeve, that they want to create a Japanification of the United States, if you will, buying your own debt. Sort of like a snake that would be eating its own tail. Okay, so
hold on. So here is their new trick, and it's not new because they've done it before. They've been doing this the whole time. The Fed is talking about expanding their balance sheet, which is what they've been doing already, by originating new debt and then buying back that new debt with newer debt. You know what I'm saying? This is the stupidest, dumbest, asinine type of play I've ever seen in my life. What business on this planet has ever created or originated a good or service, right? Don't sell it to no one else. They just buy it back from themselves. That's called a failing business. Didn't make any damn sense, but it's what they're doing, and they call it a buyback program. You see the spending? You see it, guys? Expanding your balance sheet by originating new debts via treasury bills and bonds, and then putting more money to buy back those bonds yourself. Straight trash, garbage, horse manure. That's why it's called fake numbers and fake results. Real simple. Let's go back to the thing, guys. Make no damn sense. Boy, I'll tell you something.
So what actually happened last week, and why was it so bad? And more importantly, what should we be expecting and how should we be positioning for this? Now, we're going to get to that in a minute, but first, let's dig into some of the numbers so you can understand just how bad this was. All right, so in basic terms, when the Treasury needs to borrow, they sell debt as bonds. Yep. Now, these bonds are dated anywhere from months as T-bills all the way up to bonds, which could be up to 30 years. Right. And we can see that the 30-year bond auction went about as bad as it could have. And we can see this in a couple of ways. First, there's something called the bid to cover ratio, BTC, meaning how many bids come in to cover the issuance. It's the supply and demand. Now, this is represented in a number, and this auction was 2.24, which that probably doesn't mean anything to you, but to put it into context, this used to be 2.5 or 2.6, meaning there was more demand than supply. But because foreign demand has been dropping and just, demand overall is dropping, this number has been dropping. And of course, because prices move on supply and demand. If the demand isn't sufficient, then the price has to rise.
Exactly.
And that's exactly what we see.
Yes.
This is something, or it creates something called a tail, which means that the actual price that buyers received, they received a better yield or a better interest rate than what the Treasury was actually hoping to pay.
Yes.
Now, for the 30-year bonds, the Treasury was forced to pay a 4.769% yield, which was 5 basis points higher than what they wanted and had signaled in the pre-auction trading.
Again, that's called losing money. Keep going. Keep going.
This was the tail. Now, we see tails, regularly in the markets. This is how they work. But normally we see maybe 2 to 3 points, not 5. That's why this is so shocking. It's actually the worst Treasury auction we've seen since 2011. Now, this tail shows us how weak the demand was, and it shows how the government had to basically entice investors with a premium over the market to buy their debt. Now, if we stay on the demand for buying these treasuries just for a minute, because obviously it's important, we can see some very alarming data. We can actually see who's buying this stuff, and we can see how it's trending, and hint, it's not good. Now, the auction results show us who bought the debt, broken down by, first of all, primary dealers. Primary dealers, which again are the banks, they're the buyers of last resort. They're the ones that have to buy it. Then we can see the direct bidders. These are institutional investors and individuals. And then third, we have the indirect bidders. Now, these are the foreign buyers. And what we can see is that over the 3 auctions this year in 2023, the percentages of those 3 buyers has shifted dramatically.
Listen to the shift.
So in January, we can see the foreign buyers which are the indirect buyers, the indirect bidders, they purchased about 75% of the debt. The direct bidders took about 16% of the debt, and the primary dealers, the buyers of last resort, had to take up only 9%. Now, if we fast forward to last week, we can see a massive shift in these numbers. Most notably, the foreign buyers, they've dropped from 75% of the debt all the way down to 60%.
Look at this.
And the primary dealers, they were forced to jump, the buyers of last resort, had to jump from 9% all the way up to almost 20%.
Now, do you see why your bank is offering you these CDs and at a 4.5%, 5%? They have to buy it, and they're buying more. They're buying more because they have to. They're buyers of last resort. You see the international bidders, right? Those that are outside the shores of the United States. It's going down. Why? Because of the fact that the international buyers don't want our debt. They want our goods and services. Let's keep going, guys, man. This is great information. Take some notes.
25% of the debt. Now, remember earlier, one of the points is that the Treasury made is that the primary dealers were getting nervous. Now you know why. Now, another thing to point out here is that while I highlight that foreign demand dropped off, they actually bought more in US dollar terms. So while we talk about foreign demand dropping off, they're actually still buying the same or even more in US dollar terms. It's the percentage that's dropping off because the Treasury is just releasing so much more. We can see that it went from 13.4 billion up to 14.3 billion. So it's just the percentage of the debt issuance that's dropped. Now, what this tells us is that it's not just a demand problem, right? The demand is still there. They're still buying. It's a supply problem. There's way too much supply for the existing demand that's there. The U.S.
So now, guys, that goes on and on and on. Man, he's going in. He'll go in more and more and more and more, which is fine, guys. And I'll put the link to that video, Mark Moss's video, as well as Patrick's video as well, also for you to kind of look at and kind of listen to your own. But man, he goes on for another 15 minutes, man, on this. Here's my reaction to this. All right, here we go. I am not surprised concerning what's going on with the auction bid, how the international buyers are going down, right? And the buyers of last resort, which is the banks, are going up. Now you kind of see why banks are offering CDs at 4.5, 5.0 plus percent, because they're the buyers of last resort. They have to buy these bonds, right? They got to, of these bills. They have to buy them, right? This is crazy. And you can see a buyback program. What's going to be the buyback program? You're going to have because the Fed said they're going to expand that or put a program there on it. It's already there, guys. They're just stating what they're already doing, guys. I expect to see the buyers of last resort, the banks to buy more, the international buyers, indirect buyers going down, right? I expect to see that as well. At the exact same time, also, I'm not surprised that the Fed is going to continue to expand its balance sheet by originating bonds and T-bills and buying it back from themselves. This is another trick up the sleeve, guys. This is what they're doing. This is not hard to This is not hard to not understand, right? It's not hard at all, guys. It didn't make any sense at all. Now, I agree with Patrick. The Fed Chairman Powell, if he cuts the rates because of pressure, I agree with Patrick. A reverse market crash would actually happen because of the fact that it's going to make the middle class, the gap between the middle class and the wealthy, just expand more and more and more and more and more and more and more. Because it's what they call a market crash. Up to who? The top 1%. That's the reason why my real estate is getting a lot more valuable, right? Because I'm putting fake dollars, cash to work, right? Businesses are going up. Really, businesses that actually are selling goods and services that the masses actually need, right? That's kind of the reason why you kind of see a lot of this. Real estate is going up. Rents are kind of plateauing. They go down a little bit, which is fine. It's because it has to, because the consumer can't afford this high rental rate, right? But the value of the real estate is still going up, right? Now, when they cut it, if or when he cuts it, the rates, yes, but the real estate is going to go up even more. It's going to skyrocket up, right? So will gold, so will silver. I own silver, right? I don't buy a lot of gold because to me gold's a little bit too expensive, which is fine. But I buy real estate and silver and businesses. I expect for those values to go up and up and up, right? Because that's what they call a market crash, up to the top 1%. The richest get richer. That's it. Numbers, facts, data, no spin, right? And don't take my word for it, guys. Go do your own research. Go do it. All right. I am not the end all be all, but I wanted to kind of give you, let all you pick into the rooms that I kind of be in a little bit. But Patrick, I love his team at Valuetainment, and then Mark as well. I love what he does as well. His content. Follow both of them. Follow Valuetainment. Follow the PBD podcast. Follow them, and also Mark as well. Great content, phenomenal content, guys. Man, this was just so good, man. So, financial wisdom. This section, I have a new section of the show called Financial Wisdom, right? Here's some questions I want you to ask yourself, okay? When it comes to your finances, money, right? Assets, are you self-focused or are you generationally focused? How you answer this question is going to point to why you're in the situation that you're in now. Are you self-focused or generationally focused? Right? Here's another question. Are you job focused or enterprise focused? Let me kind of unpack that a little bit, okay? Job, of course, 9 to 5, right? What I mean by job focused? Simple. If your verbiage is, I want a safe, secure job with benefits, you're job focused. If you're enterprise focused, you're saying, okay, what problem can I solve and bring that solution to the marketplace and monetize it? You see the two different perspectives there? Which one are you? Very simple. All right. Now, let me say this as well. They're not going to stop printing, guys. This is not going to happen. So you're going to have to generate more income. That is a fact. Inflation will continue to go up, right? Cost of goods will continue to go up, right? Because the producer price index, PPI, for the producers of the goods and services are going to continue to go up. The cost of capital will go up, right? Now, people are going to say, LaDale, if the Fed chairman cuts the rates, right, wouldn't it be good for the economy? It depends on where you are and what mentality that you actually have. Are you self-focused or generationally focused? Are you job-focused or are you enterprise-focused? Those two perspectives are going to be the foundation to land upon, guys, to begin to build upon, right? So if that does happen, what your next counter move is, if that makes some sense, right? That was such good information, guys. Phenomenal information. If I were you, I would rewatch this if you need to rewatch it again, because Patrick gave a lot of information, so did Mark. All right. And again, I'll put those links below. You can listen to it without my commentary, which is fine. But get your pen and pad. I would even say sit down with your family and friends and listen to what these gentlemen are saying. Unbiased. Don't bring your own assumptions to the table. Listen without any biases at all. Listen without any biases at all, so you can get the full context of what they're talking about. It's real. It's really it's simple. But here is here's the substratum of everything. You're going to have to generate more income. That's a fact. Okay, you're gonna have to do that. You're gonna have to do it, guys. That means you're gonna have to begin to recreate yourself, transform your mind, things of that nature. Okay. Try to find a solution, a problem that the marketplace needs, provide a solution, monetize it, right? And then you begin to see your income begin to outpace inflation. All right, that makes some sense. But I hope I gave you guys some wisdom here. Now, what's the counter move? Here we go. Very simple, guys. I kind of gave a little bit of it up front, but here we go. I always say, guys, peep it, sweep it, and then keep it. Always begin with this one here all the time, guys. It ain't broken up. If it ain't broke, don't fix it. Examine your current situation. That's the peep it side, okay? Have you made the necessary actions to protect your capital? When I say capital, that may mean the money in your bank account, the money in your savings, right? Or in your retirement, your 401k, your 403b, your TSPs, any retirement account, your IRA, Roth IRA. Have you made the necessary actions to protect your capital? If a lot of your wealth is tied up in cash, you are saving a depreciating asset. It is losing value due to inflation, right? All right. Number two, here's the sweep it stage. What has your current money management approach yielded you? Let's sweep it, guys. All right. In other words, is your approach working or not? You have to make an honest assessment here. Spending ain't gonna help you, but cause more pain and problems. Again, has your current market management approach? What has your current market, your money management approach yielded you? Is it working or not? It's real simple and hard. All right, and then keep it. Start thinking generationally. Get outside of you. If your solution begins and ends with you, you have failed. Your solutions should not begin and end with you. They should live beyond you. Okay? If it begins and ends with you, you failed. It's a wrap. You're done for. But if you're thinking generationally, guys, oh my word, you begin to find different solutions here and plug a hole here and here and here. That's what the greats do. We think generationally. You're also great, right? Just tweak your thinking a little bit and begin thinking generationally, right? Not just with yourself. All right. I'm not saying to not involve yourself. Yes, you do, because you're part of the solution. But the solution should be beyond you. It should be 3 generations beyond you, right? Gotcha. That makes some sense, guys. All right. Like I said, it's time to turn your hustle into an enterprise. Okay? Let me say it again. It's time to turn your side hustle into an enterprise. Okay? Small business thinking, that ain't gonna happen. That doesn't make any sense at all. It's time to begin to think enterprise-wise, whether you're building a big business or you're taking your income from your small business and beginning to invest it into real estate, gold, silver, mergers and acquisitions, funds that actually acquire companies. You're beginning to grow your net worth and protect your capital, right? By acquiring tangible assets and or businesses that generate an income, right? Like I buy silver, guys, not for the money it makes me, it's to protect me or hedge against inflation. Because as inflation goes up, the value of my silver and real estate goes up. Make sense? That's how this thing works. because you can't duplicate silver. You can't duplicate real estate or gold. You can manipulate, duplicate printing of money. It's called quantitative easing. Very simple, guys. My guys, man, give me your thoughts. What are your thoughts about what I'm talking about, guys? Let me know what's going on there. Now, a lot of people always ask me, again, leave a comment down below. Just give me your thoughts. Let me know if I'm making sense or not. Just let me know. No problem with it at all. I welcome all comments at all, and I'll respond back as well with some counsel, or say that's a good point, and give me some counsel as well. Let's sit down and let's reason together and prescribe the right solution for your family and my family as well. Also, make sense, guys. Now, most individuals always ask me this question, LaDale. How can you help me out? No problem with it at all. I can help you out sometimes, guys. Now, here is what I want to show you guys as well. If you're needing some wise counsel, all right? If you need some wise counsel, here you go with me. You can scan this QR code. It's very simple, guys. So all you got to do is, what happens is that takes you to my company calendar. You can schedule time with myself or someone on my staff. I don't know what you need. I don't know what's best for you. Right, but as the Bible states, seek wise counsel. Let's sit down, let's reason together, and see what works best for you. I know for me, to get honest with you, early on in my business career, guys, that wise counsel was pivotal for me to make those good, rational decisions for me currently and my family as well. So if you need some assistance, scan this QR code. That's it, and it's absolutely free. Doesn't cost you a dime at all. Period. All right, guys. Number two, guys, I'm always asked also when it comes to real estate, can I help? What can I help in real estate? No problem with it at all, guys. We're actually holding a real estate masterclass on Saturday, December the 9th at 12 p.m. CST. It is completely free. We're talking about how to locate, negotiate, and close distressed properties. All right. For those that are interested in real estate, scan this QR code. Very simple, guys. It will take you to a real life case study talking about the top three investment strategies for real estate. It's free, no problem with it at all. And then you can reserve your spot for the free masterclass. It's going to fill up very quickly, but it's going to be free information. It's going to be me, myself, and Cliff Hunter, a licensed appraiser and general contractor, and also real estate investor as well. He's one of my partners, guys. We're going to talk about how to locate, negotiate, and close distressed properties. We're talking about new construction, apartment complexes, and single-family residences. All right, guys? It's very simple, guys. No question is off limits. You get us for 2 hours. Ask us anything you want. All right, guys? And there's going to be a little bit of a presentation as well. We're going to walk through how to locate these. Very simple, guys. All right? Now, all right, guys. Man, that was a lot, man. And also to let you know, guys, every single Friday, guys, we have Real Estate Friday training. It is 100% free. It's on all platforms, guys. Here's a little bit of what you will actually hear on the Real Estate Live training. It's every Friday at 5 p.m. CST. Here we go. What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
That is Real Estate Friday training every Friday at 5 p.m. CST. It's your partner and Cliff, man. Come join, come kick it with us, guys. Again, 100% free. Also, in the link below, guys, you can also click on one of those links, guys. You can also get access to the calendar as well, guys. Man, this was a lot of information. I hope it was beneficial. I hope it helped you out. Again, give me your thoughts. Let me know what you guys think, guys. But you know how I end it every single Friday, guys. Before you leave, and while you can, you see that thing, guys. Take that damn picture and give it to your mom and them. Now say it with your chest and for your partner. And holler at your partner. See you guys next Thursday. All right, guys. Peace. Long live the king.